Good afternoon, ladies and gentlemen. Please allow me to introduce myself. I'm Jay Hennick, the founder and chairman of FirstService Corporation, and I'll be acting as the chair of this meeting. Before we begin the official part of the meeting, I'd like to introduce the people that are here with me today. First, Scott Patterson, the president and CEO, also a director of the company, Jeremy Rakusin, CFO, as well as Doug Cook, who's the corporate secretary. And I now would like to ask our chairman, president, CEO, Scott Patterson, who's not really the chairman, to come up and address the shareholders. Thank you, Scott.
Thank you, Jay, for chairing the meeting. And good afternoon, everyone. And welcome to our annual general meeting for 2016. It's our second as an independent public company. I'll open by saying we had a great year in 2016. We generated strong organic growth. We closed on several very important acquisitions, entered a new property service sector with huge growth potential, significantly enhanced our margins, maintained our bulletproof balance sheet, and really by any other measure, we had an excellent year. That was a brief preview. You're only going to hear good news from the podium today. I'm going to spend the next few minutes and walk you through our most notable highlights. Jeremy will then review our financial performance, and then I'll return to the podium to recognize three special guests we have with us here today, and then wrap up with some thoughts on our strategy and prospects for the future. 2016 truly was a great year for us in many ways. In terms of financial performance, our revenues were up 17%. EBITDA was up 27%, and earnings per share were up 35%. This builds on increases of 12%, 37%, and 43% that we reported last year. Our businesses over the last 2 years have performed very well, to say the least. But this is not a recent development. This is simply the most recent chapter in our long story of consistent growth. We are extremely proud that 2016 represents our 22nd consecutive year of revenue growth, with a remarkable 19% compound annual growth rate over that period. Our business model is conducive to consistent year-over-year growth. As you know, we command a leadership position in huge, highly fragmented markets, yet our market shares are modest. Residential property management, property restoration, painting, home organization, and fire protection. These are multi-billion-dollar markets where we have a top 3 position, in most cases number 1, but small market share, on average less than 5%. This presents a unique dynamic, strength combined with opportunity. The running room we have in each of our markets is enormous and allows us to grow organically year after year, and then enhance that top-line growth through selective tuck-under acquisition. There are thousands of smaller competitors in each of our markets, which creates significant long-term acquisition opportunity. We believe our business model, combined with the market attributes, will enable us to extend our track record of consistent growth for years to come. And the performance of our stock price suggests that the market shares in this belief. Our stock was up 20% during 2016. It's up a further 28% since year-end. And since our June 1, 2015 spinoff into a new public company, the stock has more than doubled. It's up 117% compared to the NASDAQ, which is up 16% over that same period of time. The market is very clearly recognizing the long-term growth opportunities we have. Now I'd like to share some of our operational highlights. In 2016, we advanced our operating strategies across the board. We had many highlights. I'd like to discuss 4 in particular. The first highlight relates to FirstService Residential, where we continue to find success in building a recognized brand and expanding our leadership across North America. We manage almost 8,000 condominium, homeowner association, and lifestyle communities comprising over 1.6 million units. In 2016, our revenues grew almost 10% to $1.1 billion, which is more than 2 times the size of our closest competitor. We continue to take share in virtually every major market across North America as the winning attributes of our service offering become more apparent in the marketplace. A key achievement for us at FirstService Residential during 2016 was a 22% increase in our EBITDA. As I have described to you in the past, we've invested heavily into this business with a goal of building a best-in-class operating platform to support our North American-wide platform. That investment is focused on 3 areas: centralizing and regionalizing back-office administrative functions, technology that streamlines our processes, and leveraging our scale to reduce costs. And we've seen the return on these investments pay off over the last 2 years as our margin has increased from 6% to 6.8% in 2015, and then to 7.6% in 2016. And we expect further improvement this year. The operating team at FirstService Residential continues to do a fantastic job at building and supporting the brand while driving profitability through innovation, through efficiency, and through scale. The second highlight was the significant level of acquisition activity. 2016 was by far our most successful year on record as we closed 13 transactions with annualized revenue of about $200 million. While each acquisition was meaningful, none were larger or more strategically significant than Century Fire, which we closed early in the year. Century is a leader in fire protection and safety across 7 states in the southeast U.S. with revenues of over $100 million. They install, repair, maintain, and inspect fire sprinkler, fire alarm, and safety systems. This is an essential property service that shares many of the same important characteristics as our other businesses, including predictable, contractual, and recurring revenue. Also, like our other markets, fire protection is a very large market and highly fragmented. There are over 4,000 service providers across North America. We see excellent opportunities to grow Century over the long term, both organically and through tuck-under acquisition. And we came out of the blocks quickly last year by closing a follow-on partnership deal with Advanced Fire in Pompano Beach, Florida. Advanced is a leading full-service fire protection company in South Florida, which is a very important market for us, given our significant presence in residential property management. Century Fire has been added to our FirstService Brands division as our 8th brand. You can see the other brands on the screen. The addition of Century was partially responsible for the huge increase in revenue and EBITDA that we saw at Brands in 2016. But there was a great deal more activity at FirstService Brands that I want to share with you. And in that regard, the third and fourth highlights relate to our company-owned strategies at California Closets and Paul Davis Restoration. Since the beginning of last year, we've closed 7 acquisitions across these 2 platforms and really moved the needle with these strategies. At California Closets, we closed the acquisition of our Los Angeles and Washington, D.C. franchises These are two key major markets that are vital to our long-term strategy. More recently, last month, we built on this momentum with the acquisition of our Orange County, California franchise, which is one of the largest operations in the California closet system. These deals bring the number of company-owned operations to 14 and closer to our goal of 20 to 25 of the major markets and 50% of the system-wide sales over the next 4 or 5 years. During the year, we also continued to improve efficiencies, quality, and turnaround times at our Phoenix-based Western manufacturing facility. And we look forward to opening our Eastern manufacturing facility this coming Monday, April 17th, in Grand Rapids, Michigan. We're right on schedule with the Grand Rapids facility, which together with Phoenix gives us the capability to serve all of our company-owned operations. And we expect to see steady improvement in the margin with these operations over the next few years as we ramp up capacity utilization at our manufacturing facilities. We also had a strong year in driving the company-owned platform at Paul Davis Restoration. We closed on acquisitions of our North Florida and Connecticut franchises, plus Paul Davis National, our large-scale disaster recovery operation. Paul Davis National has specialty equipment deployed across North America to ensure a timely response to natural disaster in collaboration with the full Paul Davis franchise network. It adds a critical capability to our company-owned operations and is strategically important in terms of stature and credibility with our national customers. This morning, we announced the acquisition of Paul Davis Omaha, which establishes a Midwest platform and brings to 5 the number of operations we own. Similar to our strategy at California Closets, we ultimately plan to own the major markets. And in the case of Paul Davis, to create a consistent, transparent service offering that is specifically targeted at our national insurance company and commercial accounts. As I said, we had many highlights. I can't cover them all, but I've given you a sense for 4 areas where we've achieved success during 2016. And now let me turn things over to Jeremy to provide a financial review.
Thank you, Scott, and good afternoon, ladies and gentlemen. As Scott highlighted in his opening remarks, in 2016, we capped off another year of very strong top through bottom line performance, underpinned by solid organic growth on the revenue line, higher acquisition activity, and continued operating margin expansion. Let me give you a bit more color. In 2016, our consolidated financial results included an increase in revenues to $1.48 billion, up 17% over the prior year. Growth in adjusted EBITDA to $130 million, up 27%, and adjusted earnings per share of $1.62, up 35% versus 2015. The top line was supported by 6% organic growth, with balanced contribution from both our residential and brands divisions, and further accelerated with 11% growth through acquisitions. On top of this strong revenue increase, we delivered superior earnings performance as we expanded our margins to 8.8% in 2016, up from 8.2% in the prior year, and an increase of 60 basis points. This was largely driven by a significant 80 basis point margin improvement at FirstService Residential, reflecting the operational efficiencies that Scott previously described. This strong level of profitability translated into a very robust $109 million in operating cash flow, a 25% increase over the prior year. Our cash and working capital management was highly efficient, delivering a better-than-expected 84% cash flow conversion rate relative to EBITDA. A significant portion of this internally generated cash was directed towards a heightened pace of acquisitions during the year. We spent $91 million to close 13 transactions, delivering $200 million in annualized revenue. This compares favorably with 2015, when we completed 9 tuck-unders with $12 million of spending and yielding $40 million in revenue. Our deal activity was broad-based, injecting growth across all of our service lines. Specifically, our 13 transactions break down as follows. A little more than half of the acquired revenues directed towards our 2 fire protection deals, Century and Advanced. Roughly a quarter of the revenues from 5 Paul Davis and California Closets company-owned acquisitions, and the balance from a half dozen tuck-unders at FirstService Residential, covering property management and pool and other amenity services. In all of these deals, we paid the right price within our valuation parameters and targeted return thresholds. As we are buying these businesses to hold, operate, and grow indefinitely for years to come, it's critically important that we maintain our purchase price discipline across all acquisition and economic market cycles, and we continue to be successful in this regard. As we look at our current tuck-under acquisition pipeline, it appears healthy, and we expect to make further additions across our businesses in the coming year. Within FirstService Residential, we are focused on property management targets that can expand our geographic footprint or add scale to our existing markets. We're also looking to broaden our ancillary services offering, ranging from building maintenance to pool and other amenities. At FirstService Brands, we continue to be active with our company-owned strategies at Paul Davis and California Closets, and now Century Fire is yet another fertile landscape for tuck-under acquisitions to augment our fire protection platform. During 2016, we also invested $29 million in support of continued internal growth of our operations. The roughly 50% increase in capital spending versus the prior year was largely earmarked towards our growing stable of company-owned operations at Paul Davis and California Closets, together with the addition of Century Fire. For 2017, we expect to invest approximately $35 million in our existing operations, including the build-out of our California Closets Eastern Manufacturing Center. And in the coming years, annual maintenance capital expenditures should run in the order of 20% of EBITDA. Turning now to our balance sheet, we closed 2016 with $208 million of net debt, and our leverage stood at 1.5 times net debt to trailing 12 months EBITDA. Just by way of comparison, this 1.5 times leverage ratio is right in line with where we ended 2015, despite $120 million of CapEx and acquisition-related investments during 2016. And compared to where we previously addressed you last April on the heels of the Century deal, our leverage has declined from the 2 times area. Furthermore, at year-end, our liquidity in terms of available cash and credit lines stood at $140 million, up $30 million since the Century acquisition. These metrics further demonstrate the very strong cash flow that we delivered in 2016. Our financial position is now stronger than ever, and we have ample capacity to finance all of our tuck-under related acquisition strategies, or to modestly dial up our leverage if we see a fit with larger attractively priced acquisition targets. Given our conservative capital structure and strong and consistent free cash flow, our board recently approved a boost to our annual dividend up to 49 cents US per share, an 11% increase over the prior 44 cents US. This is the second 10+% dividend increase since our inception as a new public company less than 2 years ago. This dividend policy shows further commitment to our shareholders, providing you with an incremental return while ensuring that we remain well-positioned to further advance our growth initiatives. Looking forward, I want to reaffirm the high-level parameters of the current 2017 year, which we previously provided to you with our year-end results in February. To recap, we expect revenues to show low double-digit revenue growth versus 2016, reflecting both healthy indicators across our businesses as well as strong contribution from further tuck-under acquisition activity. We also expect continued EBITDA margin expansion to greater than 9%, up from 8.8% in 2016. And over the longer term, we believe that our businesses in aggregate can capitalize on their market opportunities to continue delivering double-digit annual revenue growth for the foreseeable future, while operating leverage should drive stronger growth at the earnings level. With that, I'll now turn it back to Scott for a wrap-up.
Thank you, Jeremy. At this time, I would like to take a moment to recognize three very special guests that we have with us here today. During last year's meeting, I noted our passing the $1 billion revenue mark at FirstService Residential, and I reminisced about our history in this business, beginning with the acquisition of a small company in 1996. It was a $10 million business in Boca Raton, Florida, and it represented our first foray into residential property management. But it was really about 9 months later, in 1997, that we firmly established the foundation of what is today FirstService Residential. In April of 1997, 20 years ago this month, we closed the acquisitions of the Continental Group in Miami, Florida, and the Wentworth Group in Philadelphia, Pennsylvania. Together, those companies took our revenue to $60 million. And literally, overnight, we became the largest residential property management company in North America. And we haven't looked back since. And as I mentioned earlier, we topped $1.1 billion in this business in 2016. The Continental Group was led by Gene Gomberg, and the Wentworth Group was led by David Epstein and Michael Mendillo. We added 2 market-leading companies 20 years ago, but more importantly, we added 3 visionary leaders in Gene, David, and Michael, and they have been instrumental in driving the growth of this division ever since. They are the co-founders of FirstService Residential, and the culture they created and their focus and passion for service excellence has served as the blueprint for us as we built this business. Today, Gene is the chairman of FirstService Residential. David is the president of our rental management business, and Michael is the president of our East region. And we invited them here today to celebrate our 20th anniversary together as partners. And I'd like them now to stand up and please be recognized. And if you can join me in a big round of applause. Finally, I would like to share some thoughts on the future. As we look forward, our focus is on building great brands and delivering consistent growth, year in and year out. We've done it for a long period of time, and we remain committed to building on our successful track record. I described for you earlier the running room we have in each of our markets. We still have enormous opportunity to grow. To capitalize on these opportunities, we have to continue to win each and every day. We have to differentiate ourselves in the marketplace and beat our competitors. We've been reasonably successful at winning for the last 22 years, and that is a reflection on our relentless focus on employee engagement and service excellence. Our greatest differentiator is the quality of our service offering, which is wholly dependent on the professionalism and the engagement of our people. Engaged and aligned employees create happy, loyal customers, and word-of-mouth referral, which is the single most important driver of our organic growth and winning share. During 2016, we significantly increased our investment in recruiting, onboarding, and training as we continue to build a team and a culture that clearly separates us from the competition. We are increasing the investment in our people this year. Our aspiration is to define service excellence in every market that we operate. And our investment in people will reflect this aspiration for years to come. In closing, we believe we are better positioned in the market than ever before. And we are highly confident in our future growth prospects and our ability to extend our track record of consistent growth, one step at a time. I want to thank you all for joining us today and celebrating another successful year. And now we would be pleased to take any questions that you have.